So, thanks everybody for taking the time out on a Sunday morning. I've been meaning to do one of these presentations for a while. This is just I'll be covering a few topics here. It's just it's not, I don't want to make this into like some big sales pitch. I just want you guys to, look at different ways of viewing the order flow that, probably you haven't considered before, and hopefully it can make a difference in your trading. Let me just go over a couple of things. So it's the thing with order flow is, it allows traders to see things that other traders just aren't looking at, right? You're looking at the volume that's traded on the bid, the volume that's traded on the offer, and, its relationship into, the overall trading in the market. And what you're going to learn in this training is a couple of things. You're going to learn the importance of value in a bar, and I'm going to get into that a little bit deeper shortly. And you're going to learn more about imbalances. Most traders are familiar with imbalances and they look at them a certain way. I'm going to show you a different way that you can look at imbalances that can hopefully, make a difference in your trading. Because, at the end of the day, even though you're looking at information in the order flow that nobody else is looking at, you also want to look at it in different ways that everybody that's looking at the order flow is looking at. So, most of you guys already know who I am because you're on my list, but, I've got over 25 years of professional trading experience, trading at investment banks. It wasn't until I started Orderflows.com in 2015 that I started working more with retail traders. And, it's been a big shift for me because, before, when I was working in investment banks, all the traders there were all very good. Whereas when I made the switch into retail trading, trading for myself, I consider myself a retail trader now. I started interacting more and more with traders that were struggling. And, I had been trading with order flow before I started up Orderflows, and I started developing my own software to help my own trading. But then when I started sharing it with other traders, they saw improvements in their trading. And if you're not familiar with it, it's the Orderflows Trader 5.0. Just because, I created it to help myself in my own analysis because, computers can do a lot of work for you. And the reason that I bring it up is because, the charts that you're going to be seeing in this presentation are generated from my Orderflow software. Okay, so I want you to see how easy it is when you have the proper tools to analyze the order flow. I mean, it doesn't have to be so difficult that you're there scratching your head, every day looking at the chart, trying to make heads or tails of it. Really what you're doing is you're going to be looking at certain things in the order flow. You're going to be looking for certain occurrences in, the buying and selling that's going on. So, before we jump in, just, we're all adults here, but, do understand trading involves risk, okay? That's just basic. Some people think that, they're going to start trading and get a Lambo, in a week. It doesn't work that way. If it did, pretty much everybody would be driving a Lamborghini. But so most trading that happens is based on what has already happened in the market, okay? And what I mean by that is, the way most people approach the markets is they use price-based indicators. And basically, they're just looking for a market that's been rising. They'll just buy into it and hope that it continues to rise. What order flow allows you to do is see where the market moves can stop based on the shift in the buying and selling, which if you're just looking at price isn't going to give you that information, right? Because order flow is based on the premise that future prices are determined by the buying and selling pressure currently happening right now in the market. So in other words, order flow trading is about anticipating future price movements based on the movements of buy and sell orders, that are executed. And I don't want to just say buy and sell orders in general, but buy and sell orders that are executed in the market. And this type of trading can be tricky as it requires a keen understanding of market dynamics, right? You have to understand what you're looking at. You can't just put up a chart, a footprint chart, and think that you're going to get it, right? You need someone to teach you what to look for, and and teach you what different things mean in the order flow. And when it comes to trading, one of the most important things to remember is to trade in the direction of the market. Okay, so in other words, when the market's moving up, you want to get long. When the market's moving down, you want to get short. And the reason why I talk about this is because I'm going to jump into the charts in a second here. But when I take trades, right, there's a saying, right? I like to let the market get me into the trade, meaning, when the order flow sets up for a buy or for a sell, I like to see the continuing in the order flow, right? And that's important because, it's easier to make money when you're trading with the trend than it is when you're trading against it, right? You don't want to be fighting the trend. You want to be, the saying, the trend is your friend, right? You want to be trading in the direction of the trend. Secondly, trading with the trend ensures that you're always buying low and selling high, or vice versa, selling high and buying low, meaning, the market is already moving and you're getting in. It's like getting in on the elevator. You may not be getting on the first floor, you're getting in on the second floor, but you're still getting out on the 8th floor. So lastly, following the trend, I don't even like to call it the trend. I just like to call it following the order flow. It means that you're more likely to buy into rallies and sell into dips, which are great trading opportunities, right? Everyone says buy the dip. Well, you buy the dip and it keeps dipping, you look like a fool. And what would you rather be doing? Selling into the dip as it's dipping, or buying into the dip, trying to buy the dip? Now, the whole buy the dip concept became mainstream with Bitcoin. That just seems to keep going up and up and up regardless. But not all markets do that, right? The markets keep dipping, 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 dipping. So, be careful with that. And again, so let the market get you into the trade. Now, the first thing I want to talk about is value, okay? And one of the most important concepts for traders to understand is the relationship between price and value. In general, price is a function of value, but the relationship between the two is complex, right? In a trending or breakout environment, price leads value, okay? That is, price is searching for a level at which two-sided trading can resume. But if you're in a rotational environment, value is containing price as it auctions back from moves away from value. Now, when you start thinking of value, right, you start thinking of market profile and volume profile. The definition of value, and it's where 70%, I say 70% of the bar's volume traded. All right, so let's take a look at some charts here. Get my chart up here, close that down. So, most of us, we're familiar with a normal footprint chart, right? Let me get a crosshairs going up here. It's not going to help me if it's white. Crosshairs, change it to black. There we go. Okay, so most of us are familiar with a footprint chart already, right? It shows, the volume traded on the bid, the volume traded on the offer, delta, imbalances, and point of control. Okay, but point of control is not the value per se. It's more of a crude definition of value, but it's the price level where 70% of the volume has traded. Sorry, it's the point of control is the level where the most volume traded in a bar. Okay, so if you just add up all the volume at each price level, right, that's your point of control. But you could take it a step further. Okay, you can add the value area of a bar. Okay, so now what you have going on is you can see where 70% of the value of the volume rather traded in a bar. And you're going to think, well, why does that matter? Well, it's important because in a bar, knowing where majority of the volume traded is going to give you a sense of what that bar is worth. Okay, think of it like an item on the grocery shelf, what it's worth, the price of a candy bar, what it's worth. And one bar itself, may not make that big a difference, but when you start putting it in context of what's happening in the market, then it's going to make a difference. And people are going to say, well, you're looking at a 1-minute chart. What good is value on a 1-minute chart? Well, markets are fractal, right? Whether you're looking at, this is a 1-minute chart, this is that's also a 1-minute chart. This is a 5-minute chart. This is a 15-minute chart. And when you start tracking where volume is in, on different time frames, it's all the same, the same type of movements, whether it's on a 15-minute chart or whether it's on a 1-minute chart. So go back to the 1-minute chart here. Right, knowing where value is, and oftentimes what you're going to get in bars is value is going to be overlapping from bar to bar to bar, right? You can see value in this bar is right here, the next bar it's overlapping, next bar is overlapping, next bar is overlapping, next bar is overlapping, 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 okay? Then it starts to break down as the market sells off. And remember, right, if you're in a rotational market, the market is just, when price gets outside of value, it sort of comes back into value. But if we're in a market where it's trending, price is going to lead value. So if the market starts trading down, you can see price move down. Eventually, you're going to see value catch up to it. Okay, and why that's important is because it could give you signs of when a trend is starting to happen, because trends often happen when markets break out of periods of consolidation. And if you're in a period of consolidation, you want to see value, building up at a certain price level. And again, whether you're looking at a 1-minute chart, 5-minute chart, a 15-minute chart, you'd be looking for the exact same things. I got a question the other day, why do I always make videos with 1-minute charts? Because that's the most common chart that traders use in the market. Now, I know traders use 10 range chart, 2000 volume chart, the whole gamut of charts that you can imagine people use. And you could still, you're still applying the same ideas of value, whether it's a minute-based chart, a tick-based chart, a volume-based chart, a Heikin-Ashi chart. As long as you can see the footprint on there, you could add the value. So what you want to look for is when price starts to move away from the value, okay? And not just value, the value area itself, right? Because obviously, a bar is going to open and close, and it's going to have the value area. The next bar is going to open. But what you want to be looking for is when the market starts to trend, okay? And there's easy ways to see that in the order flow, all right? So just real quick here, let's get the right chart up. What you're going to do, right, if you're using the Orderflows Trader software, is we have a feature on there to draw out the value area, right? And we call it until tested, because it's until the market tests that area again. And if you're using the software, it would be under value area. You would change it here from fixed to until tested, and you just change the box size from 0. Because if you have it fixed, it's just going to draw the value area in the bar itself, right? With the box size of 0, it's not drawing it out. But if you were to change it, all of a sudden, you can draw it out now. You can sort of see it here. Just show you the difference in settings. Value area here, right? It shows until tested. It's got to be a box size more than two or more, basically. More than 1, definitely not 0, because you want to draw it out until it gets tested. And what you're going to start to see now is you're going to start to see these value areas where it's not touched by the next bar, and oftentimes by the next several bars. And that's going to give you a clue into a market that's starting to trend. So as you can see here, right, you get up here towards the swing high, you got a value area, right? It's overlapping here. The next bar doesn't even test it, right? It's well below, it's gapped down below. So price is starting to move. Price is now leading value, okay? And the market starts trending down. Here is one, this was a bullish value area, right? That's the green. And it just came back in the next bar, but then the next bar came down like this. But you're going to see these areas, like this value area right off the low of the day, okay? Next bar, well above it, right? Price is leading value. Price is leading value away. Obviously, you got a gap between the two value areas. This box here is the value area. This next bar, the box is the value area. Now, of course, you're not going to know where the value area, whether it's untouched until the next bar closes, right? Because the next bar could open up, trade around in here, and come back down and test it before the close. Wait for the next bar to settle, so you're confirmed that the value area is away from it. And you can see you got a nice move up here. Now people are going to say, well, yeah, you had one here. Okay, well, the market had already been trending down, right? And then you get the value area out there. That's not how you want to take it. You got to take what you're seeing in the order flow and use your general knowledge of the market, right? You just had, if right, if you're getting a value area that's untouched right here at 45.06, 45.04, after the market has been trading down into new lows, that's not, you probably don't really want to sell that. I'd prefer to look for reasons to be buying after you made a new low. That's what this red line is, and I'm getting it right here. Because while the market can keep going lower, it did, but it's only going lower by 2 or 3 points. I'd rather get 10 or 20 points on the way up. Here we got this market rallied up a little bit. Then you're starting to see the value areas, right, that aren't being tested, right? Price is now starting to lead the way away. Right, you see the value area, even though it gapped up here, you got overlap, 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 overlap. It's kissing the top here, overlap, overlap, a little gap up. Now it gaps down. Now you got that value area exposed, and the market drops down. Right, you hit the new low here. Right, again, where would you rather be getting short? Off of this value area here, or off of this one? Right, as you're making new lows, depends. I guess it depends on the type of trader you are. Me, I'm not always big on selling into new lows, but some guys that they love to sell into new lows. That really just depends on you. Me, I like to have reasons to be buying off of lows, and if I get something like this, I get this value area that's hasn't been touched in the next bar. It not just touch. I mean, it's not overlapping, obviously, but price doesn't even trade back into it. Right, just like here, price doesn't even trade back into that value area. That's why you're drawing out this value area zone. Right, and then you can see you got that little move up, from the, I don't know what that is, 07-ish area all the way up to about, 12, 13, 14. And, you could just go through them. You can see them, all the time. Now, when a bar is like this is a doji candle where the bar opened and closed at the same price. That's why it's gray. So if it was bearish, it would be a red color. If it was bullish, it would be a green or a blue. Right, here's a nice one, right? We got nice overlapping value areas. It looked like it was going to break down here, but then it traded right back up into this value area that we had been in. Next bar comes down, doesn't even trade back into it. Again, another bar doesn't trade back into it. And it just makes this nice move down from, this 27-ish area down into the 17 area. And earlier, I have talked about, right, just a few minutes ago, I talked about letting the market get you in. So let me expand on that a bit here. When I say let the market get you in, right, so now I have a potential sell here, okay, in this bar. Once this bar closes down, starts trading below, this is a bearish value area in the sense that we haven't gone back into that value area. Now we're below it, the bar closed. Okay, I know where the low of this bar is here at 27.5. I'd be looking to get short, anywhere in here around, 27 to 27.5, anywhere around the low of this bar, right? I don't want to be, getting short if this bar starts trading back up in, all the way up in here, right? You want to let the market confirm that it's trading down. So, you want to be lower than the low of the signal bar. Okay, that's why when I said, short around 27 for the move down, that's the area that you'd be looking to be getting short. As long as it's trading around 27, yeah, that's your sign to be getting short. Here was a little buy. Okay, so you'd be getting long somewhere around 23.75, somewhere in there. It was a move up to about the 26, 27 area. So not a big, gigantic move, but again, it's not just about getting the signal from the order flow and thinking that the trade is going to go to infinity. You still got to trade, right? You still got to read what's happening in the order flow. And when you get up into this bar, you're starting to see some bearish activity. You're starting to see market weakness. You're starting to see a bearish prominent point of control. Obviously, the market reversed here, closed lower, and then just sort of going sideways. So, you're still responsible for reading what's happening in the market. Right, another long, here's another short. And like I said, markets are fractal. This is a 5-minute chart. Okay, right? Here's this area here, right? You got your bearish value area, right? Notice how it trades right back up into that value area and falls down. When you start looking at longer term charts, you start to see the market often come back into those levels, to act as support and resistance. But on shorter time frame charts like minute-based charts, to me, it's just a go with trade. But again, I know a lot of guys that use this software and they're looking for the pullback into there to get short, but the problem is sometimes on longer term charts, you're gonna get a big zone. This is 37 down to 32 basically. So that's a 5-point zone. And, if you're getting short, right at the edge of it at 32, your stop's up here at 37. For some of you guys, that's a 5-point stop. That might be too much. But again, it depends on how you're trading, but you could scale in here as well if you're trading back, the pullbacks, right? Sometimes the pullbacks work like this one did. Sometimes market pulls back to a level and just keeps selling off. So there's different ways to trade it. But again, this is a 5-minute chart, right? You're seeing a nice move up. This is the evening session. So you're getting smaller moves. This was on the evening going into non-farm payroll, so it was pretty quiet that night. But if you look back on the day before, right, you had your zone here, okay, then it just sort of went sideways, then it started breaking down, and then you got your exposed zone in here. You're getting short around the 64-ish area, for a nice move down. Now this is a bullish value area, but you notice the market is below it. You don't want to be getting into the thought of, well, there's an exposed value area, I gotta get long or I gotta get short. No, it doesn't work that way, right? If it's a bullish one, you want to be up trading above that value area, just as if it's a bearish value area like this one, you want to be trading below it, right? You want to be trading below it. You don't want to have a red zone being drawn out and you're trading, above that red zone. See if I could find a example. Not really. You're seeing some, you don't see any. I don't have an example of the red zone where you're trading above it, but you get the idea, right? You want to be trading in the direction that value is moving. And again, if the market is trending, price is going to lead value. So if you're on a 15-minute chart, okay, you're not going to get as many, but you're going to see a few happening in here, these red zones. Get this crosshair up. Black, right? You're trading below the value area, right? Here's a doji bar. The market starts trading below. That was on Thursday. You get another doji bar, another red bar, right? The zone's being drawn out. Once these bars close and they close below, that's your sign to be getting short. Right? There's a nice one here. Again, these are 15-minute charts. Whether you're looking at a 15-minute chart, a 1-minute chart, you're looking at the same things. All right, there's a nice one here. This one was a small one here. Actually, this one, if you're getting long here, it came all the way back down, tested that low, tested that value area, and then made a half-hearted move up. This was one going into late on Tuesday, right up there. Again, it's a 15-minute chart. This one here, we traded up, came back into that zone, and then rallied up. Now, again, it's funny because someone just asked a question. I don't understand this. Well, you have to understand value, right? If you're not familiar with market profile or volume profile, what volume profile is, you're looking at where the volume trades, right? Whether it's in a bar, if you're looking at the volume profile, right, it's going to show up on the side of a bar. If you're using market profile, you're looking at you're looking at the value for a 30-minute period. What I'm saying is you take it down on a smaller time frame. You're taking it down on a 15-minute or a 5-minute or even a 1-minute chart, and you're looking for these value areas. Edward asked, any help from delta? Yeah, you can apply delta to it. Now, when you're looking at, let's go back to the 1-minute chart here. Okay, so when you're looking at delta in the order flow, right, you don't always just want to take the delta in the bar, okay, because again, oftentimes on red candles it's going to be down, negative delta on green candles it's going to be up. You sort of want to be taking it in context of what's happening in the several bars before it. Okay, so like for example here, okay, you got to buy here and you got to sell here, right, with the value areas, the zones being drawn out. And okay, it went from negative delta on the low to a positive delta to a more positive delta. Okay, that's fine. And then as you start seeing it shifting again, when you're trading with order flow, it's not like you get into the trade. It's like this for any method of trading. It's not like you just get into the trade and you set your ATM to go off, with your stop and take profits, then expect, that's the end of it, right? No, you still should be watching what's happening in the order flow. And, if you're long off of this zone here, but you see the order flow start to turn negative, then get more negative, it's gone from 411, which is a decent number, a delta, right, to 201 to just minus 102. Okay, it's weakening, right? It's getting weaker. It's not getting stronger. You're long, but all of a sudden now you're seeing aggressive sellers coming in. You're seeing the aggressive buying weakening in the sense that it's not getting stronger, right? It's going here, it went from 68 to 411. Then it went to 201. Okay, it's still positive, but not as strong as 400. If you're going to move away from the low, you're going to want to ideally do it in dramatic fashion, in the sense that you're going to have a nice positive delta, but it's just it's a small delta. It's just 201. Again, it's not negative, but it's not the end of the world. But then you see this next bar here, this red candle with the negative delta. Okay, that's not a good sign. And then obviously this next bar comes in with a stronger negative delta. So if you're long from here and your stop is somewhere, below the low of this bar, definitely below the low of this value area, that's your time to get out, right? And then once you see this bar come in, and then you got this value area being drawn out, and you see the value area is obviously lower than the previous two value areas, you're starting to think of what's happening. Okay, so if you're going to use delta, right, use it sort of in connection with what else is happening in the markets, right? Here we are at the low of the day. You got the nice strong negative delta, then positive delta. It draws out, the value area hasn't been touched in the next bar. It's got nice positive delta, 638. Then it just sort of goes sideways on you, 92, negative 262, 50, negative 70. Then it starts building up again, but it's still holding up, above that area. Obviously, this one here, again, you're coming up off your low, you're getting some deltas building up, 122, 259, 272. Hey, that's great. That's what you like to see. Comes back into this bar, right? This red candle opens up. You trade all the way into that zone, minus 60 delta. Okay, it's not the end of the world. Market does rally back up, closes, still a red candle, but it closes somewhere, towards the high end of the candle. Okay. Then this bar, you get a nice move higher, little bit. I'll say nice move, but about, you know, a point and a half higher than this high of this bar. But then it turns around and closes down. Now you're seeing some things here in the order flow sequencing. That's what this is. This is a bearish point of control. It's got a positive delta. And then this bar trades, right? You got a negative delta, 241. So, you know, you couple what you're seeing in this bar with the sequencing. That's what this purple is. This bar here with the sequencing, obviously the bearish point of control here. That's why it's red. The negative delta, okay, and you're still trading, you know, somewhere. You haven't hit your stop because your stop would be somewhere down in here around 28, and you're trading 29. Okay, you have an opportunity to get out in here around 29, take a smaller loss than getting fully stopped out. So, you know, that's how you can use delta in there. Rob asked, how can you determine the trend? Well, you watch the value, okay, simply. Obviously, you're seeing bars, you know, green bars, red bars, but what's the value areas in the bars doing? Is it migrating lower or not? Not just the point of controls, right? Because here, right, you see point of control higher, higher. So you got 1, 2, 3. 2 and 3 are both higher. Then red comes in. Then this red candle comes in. Point of control is below, obviously, these 3 bars, which is bearish. And then you're starting to see this, but this value area, this is the value area from here to here. This is the value area from here to here. They're overlapping, right? 1, 2, 3, 4, 5, 6. Now you get that gap in value between this bar and this bar, right? So naturally you should be thinking, okay, this market can start to move lower. Now, if this bar was a little bit lower, right, if it didn't trade back up into this value area, then it would have that zone drawn out. But the simple way to determine, you know, the trend of a market is watch what's happening with the values in the bars. Are they moving up or down, right? If they're overlapping, that's just something going sideways. That's why even though these points of controls are moving higher, you know, it's not anything to really get you too excited, right? Because the value areas are still overlapping. You want to be looking for, you know, gaps in the value area, because again, price is going to lead value in a trending market. Pepe asks, yeah, this is on a footprint chart. This is from the Orderflows Trader software chart. Okay, so the next thing I want to talk about is imbalances in a bar. Okay, and you know, we all familiar with what imbalances are, right? It occurs in the bar when, you know, you have more aggressive buyers than aggressive sellers, or vice versa, more aggressive sellers than aggressive buyers. And really what you're looking for with imbalances is when there are more aggressive traders in a particular direction, that's what's going to create that imbalance, right? And generally, you're expecting prices to move in that direction. But imbalances sometimes in the order flow can lead to trading activity drying up altogether, right? The trapped traders, right? Everybody talks about trapped traders as being this big market moving phenomenon. And you know, in all honesty, really what trapped traders is more of a signal of is trading activity drying up, all right, more than anything. Because oftentimes, you know, people say, oh, you know, traders are trapped, but the amount of traders that are trapped is so insignificant, it's not going to cause their it's not going to cause the market to reverse or anything like that. You know, they're buying at highs and getting out is not going to cause the market to reverse. It's, you know, basically, you know, people that got in late to the party and are long and wrong, or short in the hole. So as a result, right, again, this is the important part, imbalances in order flow. Again, this is where it differs for the sort of the norm. Imbalances in order flow could lead to trading activity drying up altogether in that direction. Okay, so it's important for traders to be aware of imbalances in order flow so they can see how they impact the market. And what I want to talk about today is inverse imbalances. Pepe, yeah, it can. I don't have data for the FTSE 100 from the Life Exchange, but it definitely can be used on FTSE. So let's go back to the charts here. So 1 minute. Okay, so right? Imbalances. Now, we're all familiar with what imbalances are, right? You see inside the candlestick, right? Inside the footprint, you're seeing red numbers or black numbers. And you're also seeing blue numbers, okay? So the black numbers in the footprint are just your normal order flow, right? There's no imbalance there. But if you're seeing a red number, where's the red number here? 37 against 2 in this two-way auction, in this bid offer, you have more aggressive selling than aggressive buying. Only 2 lots were bought aggressively, 37 were aggressively sold. So that's an imbalance. And you determine that by a certain ratio that you want to use. Most people use 4-to-1, which is fine. It's sort of like the industry standard if there was one in trading, where everyone's got their own opinion on stuff. But most people use at least 4-to-1. Again, I know people that use smaller numbers. I know people that use 3-to-1. I know people that use 5-to-1. I know people that use higher numbers, 9-to-1. But when it comes to imbalances, right? We're familiar with what stacked imbalances are, right? Yeah, this is a stacked imbalance, right? This 5, 14, 13, this is a stacked imbalance, and they make for some great trading opportunities, okay? But, everyone is familiar with what a stacked imbalance is and what a normal imbalance is, whether it's a buying imbalance or a selling imbalance. But what I want to talk about today is this thing called inverse imbalance. And if you're using the Orderflows Trader software, let me just show you guys here. It's under volume imbalance. All the stuff is alphabetical. But you can see it here, display inverse imbalance, okay? Right up here, it's checked. Now, you can see the imbalance trigger in percent is set to 400. That's 4-to-1, that's 400%. And what I'm doing on this one is I'm setting it to 2. So I'm looking for a stacked imbalance that's inverse of what you normally expect, but it's only got to be 2. And let me just show you what I'm talking about here. So where am I here? Okay, let me find it. Some days you get none, other days you get a lot. So this is what I'm talking about here. This is an inverse imbalance. So you got 2 against 73, 0 against 46, right? So you have this blue zone drawn out. This is a selling imbalance, but it's a selling imbalance in a green candle. And, sort of going back to delta, right? You got a negative delta, right? Negative 88 on a green candle. Normally, you're going to expect to see green candles have positive delta, right? And you're going to expect red candles to have negative delta. Now, how can the market go up on negative delta, right? Because aren't aggressive sellers in control of the bar, right? Because you got the negative delta. Well, the reason why the delta often is negative is because you have what's called supportive volume. Hang on, let me drink some water here. And excuse me, supportive volume, that's better, is definitely, by definition, is going to support the market, right? So you can see you got negative 88 delta. Why? It's because you have these selling imbalances, right? You have people that were bidding the market or absorbing, rather, the aggressive selling that was going on. Now, this bar here, right, you got negative 59. This is not an imbalance, 192 against 118, but I could see clearly, why you got the negative delta. But sometimes it just stands out so obvious in the order flow, right, with what we call an inverse imbalance is when you have stacked imbalances of absorption. Okay, so you can see here, right, the 73 against 2, 46 against 0. This is what we call an inverse imbalance. And again, let the market take you in, let the market start trading higher, okay? And it starts trading higher here. Eventually it worked its way up here. This is an inverse imbalance. Now this is a bearish one. That's why it's drawn red. This one failed, all right? But it's, 104 here, 74 here. It's 25 against 104. It's 11 against 74. Okay, now you do have negative delta of minus 92. So obviously there was more aggressive selling happening in this bar. Now people say, well, can you use that delta, sort of as confirmation, take the inverse imbalance as long as you got positive delta? You could, but just watch what's happening in the order flow as well. I don't like to just, sort of sometimes, we like to automate things that just make it brainless for us as traders. But, I think, the best thing we can do as traders is, still analyze the market. Now, this is like at 5:30 in the evening after the reopen. But again, it doesn't go anywhere. It just goes sideways, right? Let the market take you in. If this was going to really rally off this, you'd be looking for this next bar to at least trade higher. Doesn't even take out the high of the bar with the inverse imbalance. But let me just get you onto some more here. Again, same thing. It doesn't go anywhere. It doesn't go any higher than the signal bar. Eventually it does, but by that time it's too late. For me, I like to let the market start moving in that direction within the next, the next bar, basically, next two bars rather. Again, it's not something that happens all the time or very often. Some days you're going to get none. Some days you might get two or three. Right, so here's one here, right? This market's just coming down in here, right? You got the negative delta, I got the green candle. So there's some absorption happening in here, right? At this level, the 260 against 42, the 143 against 10, the 29 against 0. The next bar opens up. It's basically trading inside, makes a new low. Then the next bar starts trading higher. How do you trade that? Well, you got your inverse imbalance here. The high of this bar is here, right? We closed this bar just right off the high is 91. You just drop in a buy stop up here at 91 and a half, right? It moves from 91 and a half all the way up into the 95, 96, 97 area. Then more or less goes sideways. 95 is a nice exit. Again, it's not how most people would look at imbalances. Right here, you got a nice inverse imbalance, right? You got this nice green candle with big negative delta minus 1100, but the next bar doesn't go any higher. Right? Doesn't even take out the high of that bar, right? We close this bar at 76 and a half. Next bar opens up at 76 and a half, immediately trades down, right? It's not just about saying, oh, I got an inverse imbalance here. I got to just get long automatically. No, let the market take you into the trade. So that's a trade that you wouldn't be taking, but you identified it as a potential trade, right? The one back here, yeah, you would have taken, right? Because you got the follow through order flow 2 bars later. So it's all about watching what's happening in the order flow, right? You have something that's actionable that makes sense that you can understand, and then you trade with it in that direction. Okay, well, you probably wouldn't take this. This happened at 3:51 in the afternoon, but the market started going down, and then it closed for an hour, then reopened. But most of us were done trading by the cash close. And this is, I don't know what day this is, 31st into Friday. Here's one. It's a small move. It started trading higher. Just again, this was at 1:50 in the morning on non-farm payroll day, so you're not expecting much movement. So it just inched higher and went sideways and came down. Now again here, right? This is a bullish inverse imbalance, but what's happening is you're trading below it, right? That's not a trade you want to take. If it's a bullish signal, right? If it was a blue bar being drawn out, you're expecting the market to be trading above it. If it's trading below it, you're not taking it. Simple, right? Because this market, this bar, the high of this bar is what, 49? Okay, so your buy stop to get into the trade is at 9.5. It doesn't go there, right? So you're not taking the trade. Now, okay, here's one. This was, this was on the number 730, and again, I don't know if you'd want to be trading on the number, but this one it did happen. I mean, nowadays you get these numbers, there's just so much other stuff happening in the market, you probably don't want to take it. Now this was an inverse imbalance. This was a buy one, but again, similar, right? We're below it. Okay, we're trading below, right? This is a bullish one. You want to be trading above. You can't even close above. This bar doesn't even close above it, so that's not a good valid signal, right? This was a bullish, sorry, this was a bearish one. This one, okay, you got stopped out on. Let's see, here was a nice bullish one. Again, we're trading above it. Okay, fine. The high of this bar is 28. You're getting long 28 and a half. Okay, long at 28 and a half. Trades right back into that area, then immediately rallies up into, 36-ish area where it just starts to go sideways. Again, this was a bullish one, but again, we're going into the cash close. Now, this is E-minis, right? And I know not everybody trades E-minis, right? A lot of people like to trade MNQ or NASDAQ or YM. And if you're trading YM, right, with the same settings, obviously a more volatile market, you can't trade the same as a market that's less volatile, right? So you can't gonna trade, if you're trading mini Dow, right, with a stacked imbalance size of 2, you're gonna see a lot of them, right? Like this one here, here, here. You're just gonna, and it's going to be pointless because the market is so choppy in the sense of not just market, but each bar is choppy, where you're getting a lot of price, especially now with everything going on in Eastern Europe, getting a lot of bars that got zeros in them. Okay, so it's not going to be very effective. So what you're probably going to want to do is adjust it from where are we here? From 2, a stacked inverse imbalance level of 2 to 3. Okay, because now you're basically you're just adding an extra level in there, and you're going to see more clearer signals, right? This is a nice one that's coming in right here, right? This is a move from about 660 up above 700, right? Because if you're just looking at 2 levels, you're going to get a lot of them, and that's probably not going to be very useful to you because I don't want to say it's noise, but it's too, what do you want, what's the term I'd use? It's too, I'm lost on a word right now. It's too light in the sense that you're going to get a lot of them because the threshold is set so lower. But when you start raising the threshold, you're going to get fewer of them, right? This was one that didn't work, right? This looked like it was going to sell off and it just sort of hung around, went sideways, then rallied. Okay, again, that happens. And, you just want to be taking trades that have a higher chance of working out, right? So you had one nice winner and one, small loser on the mini Dow on the YM. Let's see if there's any more. This is the day before, right? This is another one right here. Okay, so this one's actually 4 levels, right? And you're talking about a move going into the lows. 24, the low for the day is 896. That's about 30-point move right there. You're looking for at least test the lows, and here test the lows and made new lows. But again, it's coming in off the low. If it was coming in right here, right at the low of the day, I'd be a little bit more hesitant. But markets love to test levels, test highs and test lows, so I'm not too concerned as long as we're far enough away from the high or the low. Here was one, right? You got that inverse imbalance kickoff right there, and again, the bar closes right here at 41. You just drop in a sell stop, 39-ish area. It goes from 39 to the next 2 bars, trades all the way from 39 down to 08, right? Then it sort of goes sideways. But again, it's all about understanding your market, right? For E-minis, you could use an inverse imbalance level of 2, whereas on mini Dow, 2 is not going to be effective at all. Again, you wouldn't take this one. This one's at 349, 350 in the afternoon. You only got 10 more minutes before CME shuts down. But again, it's not something you're going to get a lot of, but you should be on the lookout for them, because when they happen, it could result in some decent trades. This was at 5 in the morning. Was it a move? Small one. This is and again, you could draw out these zones until fixed, or I like to keep them fixed for inverse imbalances, because if it's not really paying off after 4 or 5 bars, that this is drawn out 4, 5 bars, so the signal bar is 1, 2, 3, 4, 5. If it's just hanging around there like this, you just cut it and wait for the next one. But again, an inverse imbalance differs than a regular imbalance in the sense that they may not happen every day. Regular imbalances, you're going to get them every day. This was a nice one here. You just, bar closes here, you're just dropping a buy stop right here. High is 70, you're just dropping a buy stop around 72. It trades all the way up to 120s. Almost in the next 2 bars, it's already trading 15. So if you're long from 70 to I don't know, it's a quick 30 ticks, but maybe you could hold it out for a bit more. This was one, it just came in and stopped you out, unfortunately. But again, you can see with inverse imbalances, right? It's not as often as you would like to see them, but when they come, they can result in some very nice trades. Here's one that just started working out, but then again, it's just sort of hanging around there, hanging around your entry point for 5 bars. That's why we draw this out, a certain amount of bars. I've just found that if the move doesn't happen quickly, it's probably not going to happen. I mean, it may happen eventually, or it may go up here and stop you out. That's the decision you have to make as a trader, right? You still got to trade. I'd rather get out at a smaller loss than, sort of tie myself up into a trade. I'd rather be able to get out of the trade, be done with it, and, just wait for the next trade to happen. All right, this was one started to make that move. But again, if you're dropping your sell stop in here on 57, 58, it's a move down into, well, the low is 37, 39. But hopefully you can see a different way of looking at imbalances rather than just the plain normal imbalances. I don't have time to go through every single market and explain all this, but this one, I wouldn't take because it didn't go any lower. Eventually, it sort of sold off a little bit, but again, you're looking for the market to move after within 2 bars, more or less. And again, this one, it just went one tick higher here. So, that one wouldn't have got you into it. Sometimes people ask me, hey, if there's a trade like this and it doesn't go, should I get short? I wouldn't advise. That's not how I would normally trade a market. Where it's like, oh, I get a signal and it's not working. Should I go the opposite? Probably not. But anyway, as you can see, like on the mini Dow, when you go back in time, it's not a lot. Just it's